The Japanese bond market is melting down along with their currency, and yesterday that weakness found its way into our 20-year bond auction, which bombed pretty spectacularly. Capital repatriation, how interconnected global bond markets are, and of course the yen carry trade unwind that everyone is talking about is a massive yen intervention on the way. So, of course, a intervention in the FX markets, which Japan has been known to do, would involve selling of their FX reserves, the vast majority of which are US Treasuries. Are they going to have to dump US Treasuries to defend the plummeting value of their currency? Here we can see yen denominated in dollars, and we can see that has been weakening for a while now, but accelerating as of lately. And not only that, but we also see their bond market melting down as well. We can see the Japanese 30-year yield is up from about 3% all the way up to 3.37, about 35 basis point increase just going back to the start of November. So just over the past couple of weeks. Now, how did that trickle into the US bond market? How is all this connected? Well, we had a weak 20-year bond auction yesterday. We could see a tail, 0.2 basis points, not a super significant tail on in and of itself on its own, but the bid to cover, this total amount of bids divided by total supply, you want a higher bid to cover here. This is the lowest going back to November 2024 and way below the 6-month average of 2.66. Not only that, but we only sold $16 billion of these bonds, and we couldn't even artificially juice the price, lower the yield, even by selling only 16 billion of these bonds. We, of course, see primary dealers, buyer of last resort, had the highest relative share of the auction going back to August of this year, but indirect bidders, that foreign demand, that is plummeting. So as we can see, the 6-month average 65%, and we see indirect demand at 59%. By the way, here's a chart showing the relative share bid to cover, of course, in red, or that kind of orange line. So how interconnected these bond markets are really matter. What's going on in Japan matters for us. By the way, I will link this report that the CME does. I just found out they do this. We'll link this in the description along with this article from Bloomberg talking about Japan's stimulus plan. So moving over to Japan here, we can see the meltdown in their bond market, which remember, the value of the bond, or the price of the bond, is inverse to the yield. So as the yield is screaming higher, as we see at the long end, a pretty notable bear steepener, as we see the bond yield shooting higher, what that means is the value of those bonds is plummeting. Now, who owns all those bonds? Pension funds, insurance funds, banks. They could get into a similar situation that the US found themselves in back in 2023, when we had 3 of the 4 largest bank failures in US history due to the fact that long bonds plummeted in value. They were down about 50%. And then there was a run on deposits. So, of course, the banks were insolvent. They were not able to come up with the actual cash, actual US dollars, because the bonds that they had bought at very, very low interest rates were not worth very much since interest rates had moved higher. So Japan finds itself in a conundrum similar to what the US found itself in back then, which is, do you let the regional bank fail? In the case of the US, do you let a pension fund or an insurance fund or a bank or two, do you let them fail, or do you step in to intervene? And a yen intervention is on the table for sure. We will get to what is happening with the currency in a second here, but it is important to point out that the interest rate differential has actually been narrowing. So going back to April, and I pointed this out at the time, it was one of the first videos we ever did, interest rate differentials actually went the opposite way of the dollar. This happened, it was very noticeable at the time. We can see here the white line shows dollar yen. This is the common way of looking at this particular pair, 157.5. Now, 160 is probably where they start to intervene by selling US Treasuries, dumping US Treasuries to then, of course, sell the dollar to buy the yen. That will help stabilize their currency, but of course, it could cause volatility in the US markets as well. They also own some equities too. So this could involve the sale, the dumping into the market of US equities as well. of course, here we can see that the US 10-year yield minus the Japanese 10-year yield, this is known as an interest rate differential. Now, there's two dynamics here. Of course, if you can get higher interest in the US, which is the green line going up, well, you would expect foreign capital to flow into the dollar, pushing the white line up, and then into the US 10-year because you get more yield than you do on the Japanese 10-year. So as the green line is going up, you would expect capital to flow into the dollar. That is not what's been happening going back arguably to April when interest rate differentials became disconnected. So here's the risk of repatriation. This is where Japan has run a very large current account surplus. They have been a creditor of the US, they've been a buyer of our debt. Well, higher JGB rates, Japanese government bond yield, higher JGB rates equal a more attractive yield back home. So some of that Japanese money that had bought US Treasuries might go, well, there was no yield 5 years ago, but now there's pretty juicy yield. I'm going to take my capital back home, buy some JGBs. What happens? The order of operations there, they would sell the US Treasury, which means yields up here in the US. Then they would sell the dollar because you're left with dollars. Then they would sell the dollar to buy the yen, pushing the dollar down. Then they would buy JGBs, which of course would eventually stabilize interest rates. There is an equilibrium point here at some level. That would equal US rates up, bond market yields up, dollar yen down, and JGB yields down. But there is another risk, which is the yen carry trade. So the yen carry trade, you would borrow in yen at very, very low rates. Then you'd immediately sell the yen that you just got from on a loan. You would just immediately sell the yen to buy the dollar because then you buy the US Treasury or maybe US tech stocks. A lower interest rate differential, a narrower spread here on the green line, would indicate that the carry trade is less appealing because, say back here you used to get 3.5% higher interest in the US 10-year. Well, now you only get 2.2% higher interest. So as the green line is going down, you would expect the carry trade to be less appealing. Now, of course, there's also currency hedging costs. I don't have a Bloomberg or anything like that to get that data, but very simplistically, this is kind of what is going on. Now, an unwind of the carry trade, what that would involve is a selling of US Treasuries, means rates up, inverse to the bond price, then a selling of the dollar to buy back the yen. That would equal dollar weakness or yen strength, because remember, they borrowed in yen. If the yen starts to appreciate on them, that starts to squeeze their trade. This would equal U.S. bonds down or rates up, U.S. stocks down because some of this carry trade, a lot of it is in U.S. stocks, and of course U.S. dollar down as well. Now, what is going on in our bond market? Well, we just had the NFP, the non-farm payrolls report. Unemployment is starting to tick up. So, this is good for the stock market to some degree, betting on rate cuts. All the stock market seems to care about is lower interest rates. So even if it's weak economic data, the stock market rallies because they expect lower interest rates. We can see a bit of a bull steepener just recently, just over the past couple days. But we can see that going back to the end of October, the yield curve has been steepening, kind of vacillating between a bull and a bear steepener. I will link this report, by the way. Unemployment ticked up. The actual employment came in hotter than expected. But again, remember that everything is interconnected. The point of this is to show how interconnected everything is. So when you have higher rates in Japan, again, you have these pressures that push rates here in the US up. Now, weak demand at our 20-year bond auction. Remember that what this means, the other way of saying this is the yield was not high enough to entice buyers to come in. So higher rates in one place push rates higher everywhere because, again, of the carry trade as well as that repatriation sort of dynamic. I want to mention that Japan announced a economic stimulus package yesterday to be about 21.3 trillion yen. And of course, the yen weakened spectacularly yesterday. And of course, also their bond market is weakening, yields up. So yields up in Japan equals carry trade pressure, equals also repatriation pressure as well. But there's another risk hiding here, which is yen intervention to stabilize their plummeting currency. They would sell US Treasuries. They have 1.35 trillion in foreign exchange reserves, global, or excuse me, national savings of Japan. They would sell those foreign exchange reserves, 1.1 trillion of which are US Treasuries, to raise dollars to sell the dollar to buy the yen. So a lot of risk right now coming out of Japan. Hopefully that was helpful, and I'll catch you in the next one.